Welcome to Paragon TV. I'm Randall Paul. We're here with David Young. Dave, tell us a little bit more about how you handle the black box, how you allocate the assets for a particular investor. Last time you told us that you have investors that are more oriented toward risk, some that are in the middle, and some that are very conservative. Assuming that that's already been assessed, how do you make the investment decisions for any one of those investors on a day-to-day basis?
Okay. Well, we talked about the black box, and it's not really a black box, but we called it that. But we talked about that last time when we talked about how we went through 200 categories and worked our way down to the top 20%. And then we're constantly rotating between the top 20% and using that to build our portfolio. That's one entire set of models that does that. But the other side of the equation is how much we should be invested. So do we want to be 100% invested, or do we want to be 80% invested, or 60% invested? And just for example, if we're going to be 60% invested, that means we'll have 60% of the portfolio invested in this top 20%. Mm-hmm. Or we could have 80% of the portfolio invested in that top 20%.
Based on what's going on in the market at a particular time.
Yeah, it's based on the data that we're downloading from the market. And essentially what we've got that drives that percentage allocation is a number of models. And each one of those models can be either on a buy or on a sell. And if all of the models were on a buy, we'd be 100% invested. If two of the models were on a sell, then we might just be 75% invested. If four of the models are on a sell, then we might be 50% invested. It's really, really rare for us to go down below 30% invested, but it's all driven by those models. And just to give you an idea, the models are driven by different factors. So we have trend-based models. In other words, we're trying to identify the overriding trend of the market.
Sure.
And if it's positive or negative. For example, if you've got a trend moving up and the trend is moving up like this, that's still an upward trend. Right. And we're trying to pick that up. But at the point it's starting to roll over, a lot of our trend indicators are going to start to go negative, which is going to take us out. So that doesn't mean we're automatically going to get out right before it happens to roll over. Right. It's going to have to have rolled over a little bit. Right.
Everyone says if you just hit the perfect point, but no one can ever hit the perfect point, so you work with the trend.
Right, right. And we're tracking the trend as a main indicator. We're also tracking monetary policy and where interest rates are, because the level that interest rates are at affects the valuation of the stocks. So as interest rates start to go up, it affects the stocks negatively because it decreases their valuation. Probably the most interesting indicator that we look at that I think is kind of from a different perspective is market sentiment. And that's how many people believe the markets are going up versus how many people believe the markets are going down.
How do you assess that?
There's a number of different surveys out there. There's some that just go to investment advisors and try to determine how many of them are optimistic. There's a lot that go to individual investors. There's probably 6 different ones that we look at.
I see.
But essentially, when you get to a point to where 70% of investors think the market's going up, almost always you're close to the market rolling over and going down, at least temporarily.
That's fascinating.
And when you get to a point where only 30% of the people think the market's going up, usually you've got an extremely high chance, about an 85% chance that the market's going to go up. So we track that sentiment, and that kind of gives us an advance warning before the trend starts to roll over. But those are all separate indicators that we're tracking on an ongoing basis. The simple way to put it is that we're trying to assess how much risk there is in the market at any point in time. And so if our models are showing us that the risk levels are lower than normal, we want to be more heavily invested. If those indicators are showing us that risk levels are higher than normal in the market, we want to be less invested.
In terms of the actual allocation for sectors, not just whether you're in or out of the market, but getting more specific, whether you're in transportation stocks or commodities, how do you make those decisions?
That's driven off that entirely separate set of models. So the models where we track all 200 of those sectors.
That's back in that.
That's back in that category. Okay. So you kind of divide it up as there's one set of models that's telling us where to invest, and there's another set of models telling us how aggressively we want to be invested.
I see. That's very interesting. Thanks a lot.
Thanks.
Come back and see us at the next session for Paragon TV.